Hello and welcome to our Barebone Basics Foundations of Investing training hosted by StreamlineiG. Before we get started with today's session, I wanted to kind of give a little PSA and let you know that the purpose of the BBB training, as we're calling it, Barebone Basics, is to be able to help those that are struggling with understanding the basics, the foundations of investing, whether it's stocks or angel investing, or different types of platforms that are out there that we can use. So throughout the training, I'm going to try to simplify some of this stuff and try to make sure that we start with a good solid foundation. So if you're a person that you're very familiar with stocks already, you have a good understanding about the different types of investment vehicles, you have your master's degree and MBA in finance, then this may not be for you, but you're more than welcome to join in with us. We welcome your input, your insight to be able to share, because this platform is meant to help everyone to grow and get, like I said, a basic foundation and understanding. So today we're going to cover what is a stock, why corporations issue stocks, types of companies, types of stocks, what is a broker, and we're going to share a little something that to kind of leave you thinking before we end this session. And then I'm going to offer a prize at the end that I'm sure you're going to enjoy. I wanted to do this one live tonight for you guys. However, YouTube requires a 24-hour activation, so I had to kind of pre-record this, but no worries. When this video is posted tonight, I will be live in the chat to answer any questions. So it will be just like we're live and together. So let's get started. So what is a stock? That is the prime question of the day. So what a stock, it signifies ownership within a business, within a corporation. It represents a claim of their assets and their earnings. So imagine that you have a friend that just started up a company. Now they have to have gone public, and I'll explain the difference between private and public stocks in just a moment. But imagine that there's this business that's doing pretty well, and you want to own a piece of it. You can own a piece of a corporation by purchasing what we call shares. A share is a piece of something. So if you think of a share as they're sharing ownership of their wins and their losses, their gains and their declines. So as an investor, you're trying to find companies that you want to share their wins and their losses. You want to find companies that's doing more winning than losing, of course. But as a part of that process, you actually are a partial owner of their assets, of the growth of the company, of the value of the company. So you're participating in partial ownership. Now, every company that you can purchase a part of on a public stock per se, they're going to have what's called a stock ticker. And that stock ticker is a 3 to 4 letter representation of the company's name. So when you're looking up a stock, let's say you go to Yahoo Finance, for example, you're going to find the name of the company and you're going to find a symbol. Usually it's 3 to 4 characters. For example, Apple's ticker is APPL. Usually it's close to the name itself. And you can look up what a ticker is. If you search the name of the company, usually you're going to get some type of report showing different types of information about the company, from their earnings to how much they cost, the price, to whether or not they give dividends. If they do, it's going to give you something called a dividend yield. And don't worry, I'm going to talk about all those things, just not tonight because we're doing a series. Tonight is about you getting the basic foundation, and we're going to build each week from there. So, but you need to understand what a stock ticker is, so that if for some reason we're posting some information about a company, I might just give you the ticker symbol, and I want you to understand what that ticker symbol is for. If you go to Yahoo Finance and you just put in that ticker symbol, it knows to go look for that particular company. So a ticker symbol is simply a representation of that company's name. And it's usually 3 to 4 letters. So synonyms you need to know. I had several people ask me, well, what is a share? So like I mentioned, it's a part, a piece of. You're going to see the term BBB term throughout the slide deck here. And the reason why I'm using this is sometimes it helps to learn things when we can put it in common terms. So our BBB term for a share is it's a piece of the pie. It's the piece of the pie where the pie represents a company. So when you want to purchase stocks, every stock that you buy, so let's say I buy 5 shares of Apple. 1, 2, 3, 4, 5. Each share represents a piece of the pie. So I have 5 pieces of pie. Each piece of the pie has a value. That value that I bought it for. So let's say we're just going to make up a number, even though it's higher than that right now. Let's say each piece of the pie cost us $100. Then for 5 pieces of pie, I have to pay $500. If for some reason, let's say the value of this pie increases, so the value of the business increases, and the price goes up to, let's say, $150, then my piece of pie, each piece of this company or each share of this company is now worth $150 each. I paid $100 each. So if I sold my piece of pie today to someone, or let's say back to the market, and we're going to get to that a little bit later, but if I sold my piece of pie, for each one that I decide to sell, I can sell one or I can sell all of them, but I do have to sell in increments of an entire share in most cases. There are some instances, depending on which tool you're using, that may let you sell the portion that you may have of something. But for the most part, think of selling your whole share. So if I have 5 shares, I bought them at $100. They're now worth $150. If I sold all 5 today at $150, then that means my profit, my gain, money that I've earned off of this is the difference between what I bought it for and what I sold it for. So there's a $50 profit per share that I've just made. In this case, I sold all 5, so I made $250 off of that. That's how we're looking at things when we look at stocks in general. And there's different types of investing when we're dealing with stocks, and we're going to have a complete entire session on that throughout the series. But the first thing is to understand, what is a stock? What is a stock ticker? And some of the synonyms or the terms that you may hear floating around. Watching the news, you may hear them say, you may hear the term equity. Equity and shares mean the same thing. BBB term, it's a piece of the pie. If you own equity in something, that means I own a piece or a part of something. So to keep it simple, when we say shares, we're talking about a piece of the pie. How many pieces of pie do I have? How many did I buy? How many shares did I buy? So we're trying to keep it simple because that's the whole purpose of Streamline. The purpose of Streamline is to make something simple and efficient. So if you have that understanding, then when you're going to purchase and buy things, or somebody's talking to you about your investments in stocks, or even there's some other vehicles that you can do for investing that they may use those same terms. When you hear the term shares, think of part of or a piece of something. So each share, each piece of the company, that's what that term means. So to get a good foundation before investing in anything, let's start with, why do corporations issue stocks in the first place? Why do they want your money? Why do they need your money? We're going to make a make-believe company that we're going to kind of process through a basic, simple ideal of what happens. So the BBB reason is it takes money to make money. Everyone understands that. That doesn't mean a company doesn't have any money or any capital to work with. But let's take a fake company that we're going to call Healthy Foods, Inc. Healthy Food Inc. sells, voila, healthy food. But they also have, let's say they have a restaurant or a cafe that they actually serve food in. The owner's name is Bob. And with his one location, his annual profit is $100,000. Bob finds out that if he expands his business to some other locations, he could actually increase his profit to $1 million if he opens up 5 new locations. Let's say that's what research says. And let's say in order to do this, he needs about $200,000 per store he wants to open. Now, we've already said that he has an annual profit of $100,000. If he wants to open up 5 stores, he needs about $1 million. If he has to wait 10 years at $100,000 a year, that's a long time. He wants to make that profit now. What does he do? He says, okay, how about I sell some of my ownership of this company? Right now, based off of the blue pie, he owns all the shares within the company. He has 100% ownership. There are no other owners. How many shares that totals out to be, that's later on down the line. Let's focus on his 100% ownership. Once he actually opens up and says, hey, I'm willing to share in ownership of this company if you will provide funding to help us grow. They need capital. Let's say Bob talks to Sue, Mike, and Connie, and they come up with an agreement that each of them will give a certain amount of money for a certain percentage. Let's say Sue gives 10%, purchases 10% of the company. Mike purchases 15%. That's 25, and Connie gets 25%. That's a total of 50% of the company that is now going to be owned by Sue, Mike, and Connie, and Bob still owns 50%. So Bob by himself, with just him owning the company, we've already said he's earning $100,000 a year. We've already said that the new annual profit by opening these additional locations would then be $1 million. So if the annual profit is $1 million and Mike now owns 50% of the company instead of 100%, half of $1 million is $500,000 that he is instantly making, which is so much better than $100,000. If he had to wait to do it by himself at $100,000 annual profit, if it stayed the same, he would have to wait 10 years. Well, companies don't want to wait that long. So in many cases, the reason for raising capital meaning funding that they can use for growth, for the purpose of growing, the best way to do that is to offer up some of the ownership in the company in the form of shares. So whenever you buy a share of stock, you are buying into the company, but you're providing them funds that can then be used for future growth of the company. So when you're buying a share of stock, you're buying in saying, hey, I believe in you. I believe that with this money I'm about to give you, that you're going to take it and you're going to make good of it, and it's going to be worth more later on down the line. Or some kind of way I'm going to get a good return, in other words, for the funding that I've given to buy into this company. So I use this example so you can see that it's not so much that Bob and Healthy Foods Inc. isn't profitable or they're not making money. It's that they want to grow. And growth can come in many ways. In this example, growth was by adding additional stores. It could be research and development. It could be the ability to hire more people on board, such as engineers, so that they could create and produce more. It could be for the purpose of buying more hardware or software or things that are needed for the purpose of growing the company. That's why they sell off portions of the company. Now, mind you, if you buy 1 share or 5 shares or even 100 shares, 1,000 shares, you're not going to end up with 10 to 15% of the company. Usually, when there are owners of a corporation, it's several owners. Usually, there is a main group of ownership that will always control at least 51% or higher of the company. And one of the reasons being is that a lot of times with your ownership of a share of stock, you also have voting rights. Now, that doesn't mean all stocks give you voting rights, but a lot of them do. And you'll get emails saying, hey, this is what's going on, cast your vote, or some type of notification telling you what's going on with the company because you're an owner now. So some companies do it, not all. It all depends on the type of stock that you purchase and the company itself as far as what information they're putting out there. But most of this type of stuff you can look up for yourself if you wanted to. And we're going to have an entire session on researching stocks and what information to keep up with once you buy a stock. Now, does that mean you need to check every 5 minutes? Absolutely not. It depends on the type of trader you are. Because there are different types, such as day traders. Day traders, yes, they're watching all day. That's not for me because I don't want to be a full-time trader. I'm looking more to find things that I can buy and hold on for a long term for various reasons. And we're going to get into the implications tax-wise as well a little later on in the series. But this is why corporations issue stocks. BBB reason? It takes money to make money. And I think we all understand that. So what kind of companies are out there? There are mainly two types. We have what's called private companies and public companies. A private company does not offer its shares to the public. Its stock is only traded or exchanged privately. Most of the private companies out there, they may have shares that they purchase or allow you to purchase through angel investing, which is one of the vehicles that we're going to be spending some time on as well. And this is early entry into a company. So imagine we'll take Bob and Healthy Foods Inc. and they've been in business for, let's say, 3 to 5 years. They're earning a little bit of profit, but they're trying to grow. And they're looking for people to come in and believe in them early and invest in them early. That type of investing is called angel investing, early investing. You usually can do it for much cheaper price for the shares of ownership. However, they're a little bit more riskier because of the fact that these aren't companies that have been in business for a long time. They may or may not succeed, but it's kind of like a balancing act here. So you're balancing the types of investments that you're investing in, some riskier than others, some safer than others. And so that's one of the vehicles you could look at doing if you wanted to have a little bit more risk in your portfolio. But we're going to have an entire session on angel investing a little bit later on. But the key here is private companies do not provide shares to the public. You either have to go through some type of platform that does a form of crowdfunding or angel investing type deal there. Then we have what's called public companies. Public companies' ownership is dispersed among the general public, and their shares are traded on what we call the stock market. A public company becomes public when they issue what's called an IPO. An IPO is their initial public offering. We have companies that we will hear about, for example, Uber. Airbnb has an IPO that's scheduled to come out, I believe March 2020 is what I read there. So we know of companies that are out there. Everyone's heard of Airbnb, but it's not a public company. Airbnb is private. That's why you can't buy into them unless you're buying into some form of a private exchange type vehicle. Now, once their IPO is released, they have to apply for that. You can't just say, hey, I'm a company. I want to be on the public market to buy for the general public to purchase me. It doesn't work that way. They have to get approved. It has to actually go through the SEC. There's quite a bit of things that have to occur before they can have their IPO released. Usually you'll know well in advance. There are different tools out there that you can look up IPOs. I like to keep a list of IPOs that are going to be released because I've done fairly well in the past. When Facebook was released as an IPO, I bought it at $17 a share, I believe, when they were released. And right now they're worth over $200 a share. So that's pretty good. If I were to sell all of my shares, I would have a pretty good profit there. So IPOs are one of the vehicles that we will kind of talk about, and I'll give you guys some tools that you could use if you want to look into IPOs. However, there's risk, as usual, with any type of investing, including with IPOs. But we will have an entire session on IPOs. But the main thing here is to understand the difference between a private company and a public company. When you are buying stocks, you are buying a public company. A public company sells their shares of stocks on what's called the stock market. Stock market is just simply a place where public stocks are bought and sold, a place where the buyers and sellers exchange. It used to be that this would be human beings that were all in one room and phones are ringing left and right, and kind of like what we grew up knowing, at least what I grew up knowing, stock market or Wall Street to look like, with all these people in one room yelling at the same time. That's what I always thought the stock market was. And in essence, that's pretty much what it is. It's buyers and sellers all together. So what is the BBB term for this? It's an invisible negotiation spot where buyers bid and sellers ask, or sellers sell for the price that they're asking for. So buyers will say, hey, this is how much I want to pay for a certain stock. Sellers say, well, I have stocks, some shares I want to sell, and this is how much I'm asking for. When the price meets where they agree, that's the price that it's sold for. So let's take a little bit deeper look at the stock market and talk about brokers. So if the stock market is this invisible place, and the reason why I say invisible is because a lot of that is automated now. You don't have people all in one room yelling and screaming prices and things like that. That's a lot of that's been automated and computerized. But you are not a part of that. This is how much I want to buy it for. This is how much I want to sell it for. That is not you. What we have is an intermediary called a broker. And a broker is an independent member of an exchange, stock exchange, and there are different types. And I'm going to give you the top 3 that we have in just a second here. But an independent member of an exchange, when I say an exchange, is that stock exchange, that market that we have buyers and sellers that are coming together that can do transactions on your behalf. And this is automated. So BBB term, what is a broker? It's your dealer. I think everybody understands what a dealer does. A dealer finds a deal. It finds the seller who wants to sell something and a buyer that wants to buy that something, and brings it all together at a price they all can agree on. That's what a broker does. So a broker is your dealer. What type of brokers are out there? Back in the old days, you used to talk to your broker on the phone and call up and say, hey, I want to buy 100 shares of Facebook. What price can you get it to me for? That's no longer the case. This is where the automation comes in. It's all online now. If you go to some that I've told you guys about was E-Trade, which is what I use. Robinhood, I downloaded it as well so that I can kind of go through that process with some of you guys who are using Robinhood. But there are tons of them. I mean, new ones are popping up every single day. What are some of the things you need to look for with brokers? I can't stress this enough. No commission. Commission is a fee that you would pay a broker to broker the deal for you. We're no longer doing that. You should not be paying anyone to buy stocks for you now. That is free. E-Trade is free. Robinhood is free. There's several of them out there that are free now, and we're going to see a lot more because it's hard to stay in business if you don't follow the trend. And right now the trend is commission free, which I am loving, because back in the golden days, which golden days was maybe 2 years ago, anytime I wanted to buy some stock. So let's say I wanted to buy Facebook. It didn't matter how many shares of it I wanted to buy. Every type of company I wanted to buy into or sell, because you paid commission when you buy and you paid commission when you sold, I would have to pay anywhere from $4 to $7 for commission. Well, that's taken away from my profit. I'm paying commission to buy it and to sell it. That's almost, it could be up to like $12 just to do transactions. So, no commission. I can't stress that enough. Find a broker that does not charge commission. Most of them are heading that direction. Like I said, E-Trade doesn't, Robinhood doesn't. Some of you guys are trading through your Cash App. That's commission free, but they have limitations. So when going through your brokers, find out what the limitations are when researching. Just found out from someone that with Cash App, they limit the number of trades you can do within a day. So it's free commission. Most people have Cash Apps now, so it's a tool you already have access to, and they make it pretty simple to do, but it comes with some caveats. There's limitation on trading. If you're a day trader, someone who trades on the changes of the price of a stock, because it does fluctuate throughout the day, that wouldn't be a good tool for you. You need a good account with a broker that allows you to do what we call marginal trading, to where you can actually trade based off of someone else's money. So you're giving funds to trade on, but that's another whole Oprah, as we call it, because you have to have experience to do that, and you have to be approved to have a marginal account. We're not worried about that. We're not there yet. Right now, your main focus as far as your broker, your tool, as a BBB term, your stock dealer, you want commission free, and you want to know the details of how many, are there limitations on how many stocks you can buy in a day. If you're not a person that's purchasing a lot, it really doesn't matter. But if you're doing a lot of trading throughout the day, then you want to know if there's some type of limitation or cap on how much you could do. You also want to know if there's a limit or cap on the total amount. So let's say Robinhood, let's say they put in there the details that you could only trade up to $100 a day. I would want to know that up front versus putting all of my ducks, as you would say, in this one tool that there was limitations and I didn't know up front. Personally, I use E-Trade because it lets me invest in different types of things that I like. And we're going to get in some of those vehicles a little later throughout the series. So I mentioned about the different types of exchanges. If you're ever listening to the news or watching any kind of financial program, you're going to hear them talk about the New York Stock Exchange, NYSE. That's the largest stock market. What is a stock market? It's the place where we're allowed to exchange, buy and sell shares of a company. It's invisible people to us. Our broker deals with that. But NYSE is the New York Stock Exchange, NASDAQ, and AMEX. Each of these, your stock exchange, they accept companies to be sold within their market. And they'll all have different restrictions. NYSE has the toughest restrictions as far as companies being sold on their platform or within their market. So those restrictions may be that a company has to have so many owners. They must have so much capital or so much income that they're producing. They have to be in business for so many years, or they have to have so much revenue within a year. So there are certain things that have to be approved before a company can go public. As I mentioned earlier, that you can't just say, hey, I want to go public, I own a business. Doesn't work that way. You have to be approved to be sold on the stock market. And after obtaining approval, you will have what's called an IPO, initial public offering. And that's the date that you're allowed to, that you'll be posted on a stock exchange, usually one of the three that I have listed here, to be sold to the general public. And that's how it goes. So what do you need out of all of this? Do you need to worry about which exchange stocks are being sold on? No. When you work with your broker, which typically you're not talking to a human being because this is all automated. When you go in and say, hey, I want to buy some shares of Coca-Cola. Coca-Cola's ticker price is KO, by the way. They're not going to say, hey, do you want to buy it on NYSE or NASDAQ? Nope. They're just going to go out and buy. That's why the stock exchange to you is invisible. That's not the important piece for you to learn today. But you do need to understand the terms so that if you're ever having a conversation or you hear something on the news, the New York Stock Exchange had this particular thing happen. It makes sense. It makes a little bit of sense of what's going on. So you're not left totally in the dark. Your main point to this point is, what broker are you going to use? What things do you need to look for? Number one on the list, commission free. If they're charging you commission, run. Because that's taken away from your money. You're having to pay up front to buy it. And you have to pay when you sell it, when you're paying commission to purchase stock. So there's too many free ones out there to be doing that now. So your broker is your stock dealer. You have to find which one you want to use, and it's usually online or through some type of app. So something to think about. We have talked about a good foundation to get started so you'll understand why a company is selling off a part of its business. Why are they doing this when they can own everything? It's all about the value of $1 and how I can make more with that $1. So if I could buy a stock for $1, knowing that I can get 10 tomorrow, or I could hold on to that stock and just let it sit in my savings account, which one am I going to do? I'm going to go with the one that makes me more money, that can produce more. It's more fruitful. It's multiplying. That's usually how I'm going to think about it. And I want you to keep that in mind because that's going to be important. And I'm going to give you something to think about that hopefully you'll remember this and apply it in just a second. But something to think about. Stocks are the foundation of most investment vehicles. When I talk about an investment vehicle, I'm talking about what's carrying your money to go and produce something else. So an investment vehicle is the type of investment. The thing to think about is when you think about some of the different types that are out there. So 401k, IRA, 403b, mutual funds, insurance annuities, angel investments. Part of what all of these things are made up of are stocks. Mutual funds is nothing more than a collection of stocks and bonds. So in knowing that, what's the risk of owning shares of stocks and bonds from you to the insurance company? So the risk of owning shares of stocks and bonds is shifted from you. So if it fails, if it falls or goes down, you're protected from that. But the portion of the earning, let's say they earn 15% on the money that you put in these different investment vehicles, but you're only getting 6% of the 15. By the time they take out fees, admin fees, and the portion that you get, you're not getting all of the earnings that it made off of those stocks that it owned. When I learned that was about maybe 15 years ago, 10, 15 years ago, I was on the phone with my 403B financial advisor. And I had some questions. I was already into buying stocks at that time, but I had questions that he could not answer. And I was getting very frustrated because I'm like, okay, you're getting an admin fee. You're supposed to know these things. And I did a little bit more research. And once I saw that some of the same things that I was buying on my own, as far as stocks that I was buying into, were the same things that were going in my 403B. For me, it made me a little bit frustrated. I'm not saying don't use these. I'm not a financial advisor. I might want to throw that out there first. I wholeheartedly believe in putting into all of these, as long as my job is putting into them as well, because that's free money. So if I'm working for a company that's going to put 5, 6, 7, 8% into any one of these things, for me, that's free money that I didn't have to earn. So I want it. I'm going to max out and put as much as I can in those so they'll match. But if they're not putting anything in it for me, I tend to stray a little bit, but I'm a little bit more risky of a person. So follow your own risk level as far as what you do. But I find it very interesting that the same things that I was buying into on my own, so were these investment vehicles. It's not everything that they do, but it is a part of it. Like I said, mutual funds is nothing more than a collection of stocks and bonds. And you get a part of the earnings that they make off of the money that you put into it in the first place. So it might not scratch your head, but for me, it left me thinking about that just a little bit. So do a little research, see what you can find on any one of these as far as what goes into them, and you'll be surprised. That gave me the go-ahead green light to go ahead and invest more in stocks. It got rid of the fear for me. It also told me, okay, Demetria, if you want to buy into stocks and if you're uncomfortable, why don't you go find out what others are invested in? And there's a way to do that. You can go and see what are the big companies buying. So if everyone over here at AXA Online, which is mutual funds and 403Bs accounts, if they're all buying into a particular company, then maybe I should go buy into that company. Maybe. But at least it's another avenue to kind of do checks and balances. Another way to think of this is, what if that same company, AXA, is selling everything from this particular stock? Well, if they're selling, then maybe I should be selling. But it's an alert for me to go and do my research to find out what's going on. Maybe they know something I don't know, and I need to get out while they're getting out before something happens with this company. So that's what helped me to build my strategies over time, but just something to think about. So last thing here. I posted last night that StreamlineiG, which is Streamline Income Generator, if you wanted to know what the IG stands for, this is just a short version to be able to say it, wanted to give you a prize. But I wanted it to be beneficial to where it's a learning experience, which is the whole purpose here, to share all the things that we've learned. It's myself and a few others that we've learned over time. So the first 5 people to post a picture of a stock purchased after tonight's session will receive $10 each via Cash App. It does not matter how much the purchase is. It has to be a stock, and you have to identify what its ticker symbol is in your post. So you can post a picture, a screenshot, or a picture of your phone, whatever works for you. And then in the area to write something, put in the ticker symbol for that stock. So that means you got to do a little bit of research. I'm not going to give it away, but there's an easy way to do that even while you're purchasing. So post it in the StreamlineiG Facebook group. If you're not a member, go ahead and join. I will be online for the most of the evening tonight. So go ahead and join real quick. You'll be approved immediately. Post your screenshot. If there's any personal information on your screenshot, please block that off. We don't want you to share anything that don't need to be. And like I said, type the correct ticker symbol and the company name of your stock. The first 5 people to do that, you each will get $10 paid out via Cash App. You can either inbox me your Cash App, or you can put it in your post if you're comfortable with that. And that is the first prize that we're giving away for this session. I'm going to try to do some type of prize each session, but the objective here is for you to learn and to grow. Now, what you do with that $10, that's up to you, but I sure hope you buy some stocks with it, because you can buy portions of stocks if you use the right tool. So that is the StreamlineiG Prize of the evening. As you post, I will count it off and I will acknowledge that you have won the prize, so that everyone will know how many seats are left available to win the $10 prize. And once I have cash apped you the funds, you will also get a response from me showing that that has been done. And if you can acknowledge that you received the $10, that would be great. I greatly appreciate it. Just because I want to make sure everyone's taken care of. We definitely believe in being fair, honest, and having integrity about what we do. Try to, at least. So that's the prize for the day. Happy hunting for your stocks. So if you have any questions, please feel free to send an email to questions@streamlineig.com. As I stated, I wanted to do this live, but YouTube has a 24-hour waiting period to activate the live sessions. So I am pre-recording this video this evening and posting it at our allotted time. And I will be in the chat answering questions if you have any, or like I said, you can always send me an email. So happy hunting. Can't wait to see what you guys come up with for your stocks. And it'll be a great learning experience. And there's a little gotcha at the end of this. After I get the first 5, my goal is to create another video to talk about the stocks that you purchased and give you a little bit of tips. And that one I'll go live and on camera with, so we can actually have some how would I put it? We'll have you'll be able to see me and talk. I wish I could see you at the same time if we were all online together, but that's coming soon. We'll make that happen. So with that being said, have a great day. I hope you enjoyed. And this was the first session of our BBB investment training. Can't wait to come up with the second one. Have a great evening. Bye.